Good afternoon, everybody. I thought in the light to set the tone, really, or to follow the tone, I thought I'd like to cheer you up with an uplifting anecdote from the Weimar hyperinflation. And this concerns a gentleman who passed away and left his wealth to his two sons. The one son then did all the right things. He invested prudently in safe government bonds, and he was utterly ruined. The other son then did the opposite. He drank most of his inheritance, he wasted the rest, and then he made a fortune on the empty bottles. And my point is that I think this is where we're heading, both in Europe and in the United States. Now, obviously, as we know, states have claimed the right to manipulate money for thousands of years, but all such systems were created basically to finance government expenditures, and all of them led to major economic disruption and ultimate failure. Now, I would say that the same is happening again with the fiat system that prevailed since the 1970s. Remember that the underlying principle of this system is that central banks and governments can spend what they like, free of any real constraints. You just kick the can down the road, it's not your problem. The result is that the dollar has lost some 83% or more of its purchasing power, and we now face an escalating systemic solvency crisis. And yet, instead of correcting this crisis by painful solutions that are required, I think current policies are driven by a desperate attempt to postpone the day of reckoning. But as somebody's already said, tomorrow eventually comes, and it's here. So just briefly going through this, I think if we look at the impact of low monetary policies as an easy start, we're all familiar, I think, with the Austrian malinvestment theory, etc., which requires painful restructuring to get the maladjustments out of the system. We're also aware of the fact that low interest rate policies create destabilizing asset bubbles. I would say that such intervention is wrong on principle and creates a huge amount of unnecessary instability. A third effect has been almost unnoticed. A third effect of low interest rate policy, and that is to encourage the replacement of capital by labour, and therefore creates high unemployment. And one can see this if one compares the current situation with low interest rates with the high interest rates of 30 years ago. 30 years ago, we saw large-scale obsolescence of the capital stock and a very robust recovery in the job market. So unemployment recovered very strongly. Now we have labour that is being substituted out, and we see a level of long-term unemployment that is reminiscent of the 1930s. It's a very serious problem. And a fourth effect is to encourage outsourcing of jobs and even innovation abroad. And turning now to the financial system, one has to say that state intervention here is profoundly damaging. Just to give one example, deposit insurance, this essentially creates a race to the bottom, culminating eventually in the collapse of the banking system. And to give you an example of the kind of regulatory responses to this, namely capital regulation, the idea here is that we know that the banks are getting weaker, so we force them to increase their capital ratios. The fact is it just doesn't work. Just to give you an example here, take the rule in Basel, the international capital rule, that says that a loan to a sovereign is a zero risk. That's still the case. So this is self-evidently nonsense, as Greece illustrates. It's also highly counterproductive because it incentivizes banks to hold sovereign government debt. And this, of course, is a key driver in the Eurozone crisis. That's just one example, but pulling them all together, we end up with a highly dysfunctional banking system that is only kept going by a combination of zero interest rates and state life support. We have a situation where the bankers no longer have any interest in the long-term survival of their own banks and are entirely fixated with their own short-term profit. So to cut to the chase, the modern investment banker's task is to construct a highly lucrative witch's brew, basically gaming all these senseless rules, and the kind of the ingredients of this witch's brew are accounting standards that allow them to record fake profits using dodgy models. We have compensation practices that allow these fake profits to be distributed. We have rating agencies that are just as conflicted as the banks. use the same dodgy models, etc., etc. And of course, underlying this, we have dodgy financial engineering, which enables bankers to slice and dice risks to maximum personal advantage. And so the bottom line is we end up with a situation where the banks can extract maximum rent from the financial system, and thanks to government intervention, from the rest of the economy as well.